Good morning, ladies and gentlemen. Well, nothing new. The risk dial is firmly stuck in the worst possible, scores in the minus 90s. As I will never tire of telling you, this model is not going to catch a low. It's not designed to do that. It's designed to keep you for weeks and months on end into the asset which will have the least problems. And that at the moment is bonds and TLT, and this isn't going to change anytime soon. It'll be weeks and months before this changes, even if we were to get some major lows happening at the moment. So I'm not really going to rely on this for trading. I'm more relying on this on positioning and for when it turns to get the a long-term trend going. So nothing new here. So what I'm going to cover today really has nothing to do with the risk dial, but we have to keep it in the back of our mind that we are still in risk off, and we will be in risk off for the foreseeable future, certainly for several weeks and probably months. Just because we're going to be in risk off for quite some time does not mean that you're not going to have significant bounces in the market. Now, the market definitely has stabilized last week. Definitely. If you look at deviations, you will see that we are no longer bumping down inside the green zone. We are now stabilizing well inside the white zone, and I really would not be utterly surprised if in the next 2 or 3 months we actually went up to meet the dotted line, which is the center line of the down move. So what I think we're likely to get is some kind of a W or a three-legged advance back towards these kind of levels. And why do I think that? Well, I'll cover that in detail, but if you have a look at all the sectors, you will find that the ones which have the least problems are the ones which are defensive. So you're talking about XLV and XLP. Those two sectors are really having. This is XLV. You can see how it's basically staying near the highs, and this is XLP, and you can see how it's right at the highs. These two sectors alone are not enough to drive the SPY very much higher, but they are enough to stabilize it and to make it and to make the squeezes happen. The XLY, which is the one which can drive the market, is getting towards support, and all it needs is stabilization here for the other sectors to be able to drive the S&P a little bit higher, back up towards the 26, 25 area, which is 140 points, 150 points. It's just not to be sneezed at. I think all of these sectors are going to be bumping around, all the aggressive sectors are going to be bumping around this kind of bottom, while the other sectors take you higher. You will see from the spreads that IWM is now poised for quite some recovery, I think, and that also will be positive. What is going to make us go positive? Well, I have a small theory which I will now share with you. This is the screenshot from the White House presentation last week, where they're looking for peak deaths to occur sometime around the 15th of April and then a descending curve. Well, I think they're probably within the ballpark. Whether the peak deaths is on the 15th of April or the 18th of April, who cares? That is not what the market is going to look for. What the market is going to look for is the response by asset managers to the peak debts, and therefore looking for a reopening of the economy sometimes in June or July. Sometimes towards the middle of June, if these figures are correct, you can bet your bottom dollar that Trump is going to go, let's go, boys, let's reopen the economy, and probably it's going to happen state by state. What would make sense? I know what I'm doing. I'm buying the market to sell it to these guys who want to buy it on April the 15th when the fact is out. So I'm basically buying the rumor to sell the fact. To me, it makes sense that when these guys come in, the market is ready to unload onto them, and the market is not gonna let them buy 2400s. The market is gonna make them buy 2700s. But one step at a time. Let us see where all the markets are, and see whether my theory about the next week being a positive week for equities is grounded in some fact. I told you last week that to forget about the absolute level of 10 years and 30 years and 2 years and 5 years and just look at the curve. And I said the curve is going to have support around 36.30. I mean, I couldn't have got it more right, really. The fact that it's not going through this 35.30 level, to me indicates that we have potential to go back up into the 50s and 60s and get a steepening of the yield curve, which would indicate to me that some risk on is coming into the market. It just doesn't make sense to me that we will let people buy at the absolute lows when we have peak deaths. You are not going to buy after the fact at the same price. The market is just not going to let you. Therefore, to me, it would make sense to get a steepening in the next couple of weeks, and that will drive a modest amount of risk on. If I'm right, I would expect the differential between bonds and treasuries to start coming in and basically test 124 and possibly go a little bit higher, but certainly no higher than 151, 150. So that is the kind of move that I'd expect. I'd expect a 20-30 basis points move to the upside in this spread, and that is actually going to show the stabilization that is happening in the market, and that people are prepared to take more risk and therefore take away from bonds and put into equities. The prime beneficiary of that should be this kind of move into between 125 and 150, let's call it, somewhere around here, 134, that kind of move. That should happen in the course of the next 2 weeks, at least in terms of direction wise, which would give you an idea that we are in risk on. What would I hope to see from the dollar and from gold in the next couple of weeks if I'm right? Well, sideways. That's what I would hope for, because too strong a dollar, and this is the weekly chart of the Dixie, too strong a dollar derails it, and too weak of a dollar, well, means there's something wrong. So I would just hope to see it sideways between 98.50 and say 101 or something like that. Looking at it in more detail, maybe say 101.92, 102, something like this for the next couple of weeks. That is all I'm looking for, because it's quite obvious that the dollar is a potential wrecking ball. And if it starts getting too strong because the flows are too strong, it'll affect all the markets. It'll make the S&P far too expensive. And if it starts pushing 104 and things like that, then I'm going to be very worried about risk on. The dollar has been so difficult to trade. Really, it's been one of those wait for a level and hope you're right. It's quite obvious to me that 98.33 is now becoming the new 96.50. We have shifted up, and really every time it gets close to 98.33, it's time to buy calls, and even volatility, because from here, after a few weeks of sideways, which I'm sincerely hoping for, we have the potential to go much, much higher. Gold gives me basically the same idea. It's trading very well inside these weekly Bollingers. What a move the past couple of weeks off this 1458 level. I'm very pleased with that. I think, we trade between 1700 and 1600 for a couple of weeks. That's what I would really hope to see, and that would match excuse me, that would match the my view for the dollar and my view for bonds. That we get a bit of a steepening in the yield curve that weakens gold a little bit, but not too much, while the dollar going sideways is a bit supportive for gold. So, that's what I would hope to see, 1600, 1700 for a couple of weeks, which allows a modest amount of risk on to go into the SPX. Volatility is still a very good predictor of what prices in the risk sector will do. I've told you this 43 level, I think we trade it, and we will basically trade around this 43 level for a while, matching this kind of behavior. But this is telling me that the market is now really calming down, and that while we are not getting huge amounts of risk off, you can see how we've come off 15%, 15 basis point, 1,500 basis points, in fact, in volatility, while we actually came off small in the S&Ps last week. But that is telling you that the market is calming down, and not to look for very large moves on the downside. Well, if you don't get very large moves on the downside, I think it's more than logical that you're going to get squeezes up as people accumulate positions to sell them onto the people who will want to buy once peak deaths has occurred and a reopening date is more or less set in the market. So to me, anything around this 40 level is time to get out of the short volatility trade. The risk reward isn't going to be all that great. If we look at what is happening on the dailies, that will actually reinforce that view. You will see where this lower Bollinger Band comes in, right around 43. It's normal that we get there and then start bouncing off it. So once we get to the low 40s in the volatility sector, I think it's probably time to get the hell out of the short trade. What do I think about risk? Well, I've told you, I think it's too simplistic to assume that we will be allowed to buy the peak death scenario at 2400 or lower. I think they will force the people who are late to the trade to pay 2630, 2675, that kind of area in the next couple of weeks as these moving averages come down and tag them. To me, it's just too simplistic. There's no way the market is going to allow you to buy cheap unless it's going a lot lower. So since I know that there are a lot of people waiting for the next 2 weeks to see the peak death scenario, well, they'll end up paying up here. This is the kind of level 2630, 2675 that you no longer want to be in the trade, because it's really, the risk reward is very, very poor. If we look at a monthly chart, you see that we can easily come up and touch the 2606 level, for example. We have a moving average there. The market actually is hugging this the lower Bollinger. It can easily go up a little bit. We're only talking about in 2600, so what we're talking about 150 points, something like that. That's something that we can do in a couple of afternoons. It's really not a big deal. I'm not looking for an extreme. I am looking for a market which basically makes people pay up for something which is obvious, that we are going to reach peak deaths. I mean, of course we're going to reach peak deaths, but that doesn't mean that the market is automatically a buy because we've reached peak deaths and we have a reopening date. That just means that we are not in a complete collapse mode. That doesn't mean that you're supposed to buy the market. To me, that probably means that what we are going to see is some kind of a W, but the W is going to take place. The peak of the W is going to take place at peak deaths, and then people probably realize that it's not as simple as that. The reopening is not going to be very easy, so we get the double dip and then we go again. This is going to take a long time to resolve itself, but I would definitely argue that it's time to buy for a quick 150 points higher. In spread land, there's only one thing I'd like to make you aware of, and that is that we are at the target that I set in SPX over IWM, which is the Russell. To me, this trade is now done, and we can have a move all the way back down towards 21 in the next few weeks. That to me is a risk on type move, and it basically gels with what I've been saying about a small amount of risk on coming in the next couple of weeks, anticipating this turn. This trade has been monster. Time to get out and go the other way. I'm going to be a big buyer of IWM calls over the next few days. And finally, I just want to reiterate this SPY TLT chart. All I'm really looking for is a move back up towards 160, 165, these kind of levels in here. And this is actually where Trump got elected back in late 2016. That is all I'm looking for. It's not a huge move up that I'm looking for in the S&Ps, but certainly this chart tells me that it allows for quite some retracement of this huge move down here over the course of the next couple of weeks. So that actually confirms my bullishness for the next couple of weeks in SPY. I'll be watching it very, very closely. If it starts going down through these levels, I'm big time wrong, and it's going all the way down to these levels and then probably down to 92. So I'm willing to give it a shot to the upside with a very weary eye. Because it just makes sense to me. Okay, thank you very much indeed, and tweet you on Monday.